I hope everybody is able to see the screen. Hello everyone and welcome. My name is Dhanashri Bade, and on behalf of IIT Alumni Association of Southern California, I'm delighted to have you join us today for Equity Investing, a practitioner's perspective. The turnout is remarkable. It speaks to the passion of this community for continuous learning. So, for those who are new here, we just want to give a short introduction about, sorry, we just want to give a short introduction to our community. So, the IIT Alumni Association of Southern California is a growing network of 3,000 alumni representing all 23 IITs. Our events span a wide range of topics, and today is no exception. IITians always have a first principle mindset to every problem they tackle, and investing is no different. And that's the spirit we are bringing to you today. We have an exciting lineup ahead. So we have events ranging like future of H1B immigration on February 28, series of golf webcast on March 7 and April 11. And we have a very interesting three-episode series on agentic AI on March 14, April 4, and Vibe Coding on May 2, which are hosted by the ex-CTO of Microsoft. And apart from that, we are also looking forward to our in-person Holi celebration in San Diego on March 21st. And mark your calendars for IIT 2026. This is our global Pan IIT conference in Long Beach from April 22 to 25, bringing together world-class leaders across technology, health, climate, investment, and leadership. We would love for you to follow us on LinkedIn to stay updated. And if you're an IITian and you're still not the part of our WhatsApp group, please reach out to us so that we can add you. We'd love for you to join. Now, before we start, a few housekeeping rules. The session will be recorded and will be published on IIT Alumni SoCal YouTube channel. Please stay muted during the presentation so that there are no interruptions for the speaker. We would request you to please turn off your videos too in order to prevent any distractions. And please submit your questions through the Q&A section. Our speakers will address them at the end. Now, a very important note, a very important one. Today is not about stock tips, options, or short-term trading. We are here to explore the mindset and discipline behind intelligent long-term capital allocation through value investing. So that's one thing. And now, uh, we are privileged to have two exceptional IIT alumni with us today. Sachin Talati, he is an IIT Bombay alumnus and a UC San Diego alumnus. He discovered value investing while reading Intelligent Investor as a physics PhD student. His analytical edge is forged across 50 plus research papers, 10 plus patent, and a very exceptional career as a leadership roles at Qualcomm, Amazon, Meta, and right now at GM. He has spent over 7 years building a verifiable track record by compounding his IRA at 17.6% annualized compounding before founding 26 Value Partners in 2023. And since the inception, his fund has compounded at 19.5% annualized, guided by one simple principle: take care of the downside, and upside will take care of itself. And joining him is Amit Mahajan, an IIT Kharagpur and UC Berkeley alumnus. He brings over 2 decades of senior leadership at Qualcomm. And along with his engineering, he has built a parallel in disciplined investing practice, deeply shaped by philosophies of Warren Buffett and Charlie Munger. And his investing approach is anchored in rational thinking, long-term compounding, and an unwavering focus on value investing. So together, both of our speakers bring intelligent rigor, real-world experience, and practitioners' discipline to the art of intelligent investing. And with that, I'll just pass on the floor to Sachin and Amit. So over to you.
Yeah, thanks, Dhanashri, for the kind introduction and setting the stage for this talk. Hello, everyone. My name is Amit Mahajan. I'm an IIT Kharagpur and a UC Berkeley alumnus, techie by profession, working at Qualcomm. So earlier on in my career, I heard this saying that money might not solve all your problems, but it'll definitely solve your money problems. So, that's how I embarked on this wealth creation journey for myself and my family. And I've loved it so far, doing well on this journey. I think probably partly in my genes because, my dad was a banker and we used to talk a lot about this. Now, why this talk today? So, on this journey, I've been burnt a lot of times and I've learned a lot as well. So, while I've done well, there have been times where I was like, damn, if I wish I knew this one thing earlier or this another thing. So, the hope is that the perspectives that are shared today in this talk, they help our audience, with learning some of those mistakes as from our experiences, and they can address it sooner than what we did. Also, I think we most of us will agree that we are living in an era of FOMO driven investing these days, partly triggered the last many years, zero interest rates, AI. So the hope also is that this session brings clarity and grounded thinking, from our experiences over the last 2+ decades. The scope of this talk, like Dhanashri mentioned, we'll talk only equities. We're not going to discuss other asset classes because they are a whole kind of talk by themselves, each of them. What we hope you'll get out of this talk is you understand how battle hardened and I would say often wounded investors learn, fail, and then refine their thinking for better long term compounding. So, hoping you all find this talk useful from those perspectives. Now, before I welcome my guest here, let's do a quick audience poll. So, Dhanashri, if you could please bring it up.
Yeah, give me 1 second. The poll is live.
Yeah. So, a quick poll here for the audience. What quality is more important for a successful investing career? Is this strong mathematical modeling or not being affected by market volatility? So we'll give about maybe 10 seconds or so to get the poll results here. All right, Dhanashri, can you bring it?
Yes. Yeah. Okay. Sharing the results now.
Wow, we have a very smart, good audience here. Seems like they have been on this journey and been, some of them have been burned by similar things. Glad to see this and hoping, the talk shapes your perspectives on this topic even more strongly. So, with that, I'd like to welcome our guest again, Sachin Talati. Sachin, welcome to the SoCal Talk series. Now, Sachin, when I was looking at your bio, went through some of the material on your website, your partnership, 26 Value Partners. I think one thing I realized is you've been shaped on this journey through these value investing principles, starting maybe somewhere in the early 2000s by this book that you've came across and read, which is also displayed here, by the way, The Intelligent Investor. And that triggered a like a change inside, led to this wonderful journey so far. So why don't you walk our audience through that, investing journey of yours?
Yeah, Amit. First of all, let me start by thanking this organization, SoCal IIT, a pretty impressive group of people, for inviting me and giving me this opportunity to talk about something that I'm really passionate about. Now, before I say anything, I just want to provide this disclaimer. This discussion today is, I would say, only for education and entertainment purposes. Nothing that I say or do accounts for investment suggestions or so just this is purely entertainment and uh, discussions around education. So with that caveat out of the picture, so yeah, as Dhanashri mentioned in the introduction, and then you mentioned, I got into this journey, which I started in my second year of my grad school at UC San Diego, through the book which is highlighted behind you on the screen. So like most folks here, I'm assuming many of them are from IITs, various IITs. We go through rigorous analytical training in your undergraduate days. And if you're not economics major, you probably take one or two courses in economics. And that's pretty much your awareness of financial markets in your undergraduate training. And you come to America to do grad school or whatever. Even then, your specialization is mostly engineering or sciences, and you have no insights into or visibility into the world of finance. So I just happened to be lucky to find a roommate who was an American from New York. Guys from New York are just born to be investors, it seems. So this guy was a chemist, PhD, but he was trading and studying about markets and investing and talking about it pretty much all day with me. And that's how I got to know this idea of investing. He introduced me to this book, Intelligent Investor, which was the first book that I actually read, and I had to do anything about investing. Now, the funny thing that I have noticed over the years, whenever I give this book to my friends, colleagues, they take this book, they start reading, and then throw it away. That's one cohort of people, and the other cohort of people who just devour the book end to end. And now, for me, it happened to be the case that I fell into the second category. I mean, the book has shaped me and my journey investing pretty much throughout my life. Uh, so, just to summarize, two important key nuggets or pieces of ideas from the book that has stuck with me. One of them is in chapter 8, where Graham introduces this idea of Mr. Market being a manic depressive person. And the second idea is in chapter 20, where he introduces the idea of margin of safety or the beauty of buying 50 cent dollars, right? Now, if those are two key principles that have really stuck with me throughout my journey, and that has evolved me into what I call myself a contrarian value investor. Um, so as I've been investing over a period of 20 years, around 2014, 2015, I decided that this is something that I see myself doing when I'm retired, into my 70s, 80s, if I live that long. So I wanted to formalize my approach in writing. And before that, I wanted to make sure that I wanted myself to be what I call financially independent. So that journey started for me very seriously in 2015 when I started logging my activities on a blog, my personal blog. That evolved.
Sachin, sorry to interrupt you. I think some folks are saying logistics. If you can increase your volume a bit,
Oh, okay, is it?
that will help.
Sorry about that. And I have cold, so just give me 1 second. Let me step
Yeah,
this out.
thank you.
It's my volume. Is there? Let me see.
Yeah, make it maximum or maybe get closer to the. Uh,
Can you hear me? Hello?
yeah, it is. It is. It is better. I think.
Okay.
Thank you. Yeah,
So yeah, I also try to speak loudly.
thank you.
So as I was saying, I codified my thoughts and my ideas and my approach to investing uh, through this idea that I wanted to be financially independent first. That journey evolved from 2015 to 2022 when I felt comfortable enough to say, hey, I can take a step back and really start focusing on my passion. And that's when I started this partnership. It's called 26 Value Partners, where I have codified all my investment ideas and principles. And that's the forum through which I now invest. So that's briefly my journey of investing
So, Sachin, thank you for sharing that perspective and how you evolved from that PhD student to where you are today, where you are not just doing your technology work at some of these major corporations, but also your partnership. So, you talked about intelligent investor, and I agree. I mean, even when I read the book, it was like, a light bulb, which is like, oh wow, this makes so much sense. Clicked up, you mentioned things like finding cheap stuff or finding value, and then maybe having the patience to wait when the market gives you that opportunity. Now, these are principles which are very, easy to understand when you talk about it logically. But like you said, it clicked for you, it clicked for me. But a lot of people just kind of throw it away. They say, "What the hell is this?" Why do you think that is the case? If you could maybe just give your quick thoughts on that.
Yeah, that's a very good question. So I mean, I have also observed this, what you just said, right? And people either completely fall in love with this book and idea, or they just completely ignore it. So it's sort of a binary outcome. Not, I really don't have a very good insights into why anyone would not want to buy things cheap and then with this idea of making money in the long run. So I really don't know why people don't like that idea, but I can certainly understand this idea that when Graham introduced this idea of what is called manic depressive Mr. Market. I mean, when we think of a person who's manic depressive, we assume that this person is certainly not rational, right? And then so this book was published in 1920s. And in 1950s, Harry Markowitz published his famous paper for which he got Nobel Prize, and that's how the world was introduced to this idea of modern portfolio theory, right? Now that work is based on rigorous mathematics, and most of us techie guys from IITs are very good analytically. So we almost naturally sort of get aligned towards the concept of if you can define my ideas mathematically in a principled way, those make sense to us. And I think that the basic premise of MPT is something called efficient market hypothesis. And the assumption there is that the information about any stock or equity is priced in at pretty much all consistently at all moments in time. Now, if you make that assumption, then does it make sense that Mr. Market can be manic depressive because it's just almost polar opposite of this idea of a rational market, right? And I think people who are more analytical, therefore, cannot sort of convince themselves that, if I believe in modern portfolio theory and if I believe in efficient market hypothesis, and if I believe in this idea that was promoted in a book called A Random Walk Down the Wall Street, that it's almost impossible to make money in the markets because human beings, not human beings, the investors are rational, and market prices are exact reflection of the worth of the firm at any given point in time.
Okay. So yeah, I think we'll come to this topic maybe a few more times, like how high IQ and what we've kind of learned over the years shapes our thinking, but that might not align very well with some of these investing principles the greats have taught us. So this book, of course, impacted you a lot, and it has shaped your philosophy. Could you maybe walk us through your philosophy and the core principles, maybe the top few principles for our audience?
Surely. So as I said, when I've been through this journey for last 20 years, and in last I would say 3 4 years, I really have been able to rationalize in my mind what are the key ideas that have worked for me, and I have codified them into what I call investment philosophy or investment principles, and there are 9 of them. They are listed on my website. Now I'll talk about the most top three in my mind, and all are important. All play a role in my investment decisions and how I invest. But the most important, I would say, there's a philosophy that I tend to certainly follow is, first of all, my first principle is keep it simple. Now, what I mean by keep it simple is, as it says, in investment, you don't have to be genius to make money, or there are no points that someone gives you to make more money if you have solved some hard problem. So why worry about hard problems, right? If you can figure out things that are simple to understand, if you can explain to your grandmother, that's even better. So that's just keep it simple. A second philosophy.
Tell us about that. Like when you say don't solve a hard problem, tell us about what this audience might be doing, which they are solving, but it's a hard problem that they don't need to solve when it comes to investing? Maybe solve it for the tech careers, but not here.
Right. So I'll give you an example, right? I mean, you mentioned that we live in an AI world, right? Now, one of the big darlings of AI world is NVIDIA's. Now, if you really want to understand why NVIDIA is so amazing and what the product is, in this case GPU, and if you really want to make sense of this question, whether that product is going to survive for next 20 years, you really need to understand the technology stack. And that's too much work in my mind. I think certain people are very good at that, but certain people probably are not. So there is no reason for me, if I don't understand the technology, to worry about investing in NVIDIA. So the pond of investment and the beauty of investing is that each person to its own, in the sense that you have to find your tribe. And if you happen to find your tribe and if you understand your personal field of competence, it's better to stay in that pond and not worry about what are called error of omission, right? NVIDIA probably is outside the, my expertise domain, and someone else is making a lot of money in it. Great for them. It's not for me. I'm happy to stay within my pond of expertise. So that's what I mean by it, and it follows naturally into the next two principles, which are very, very important to actually make money over long term, right? And I'll explain that. So my second principle is um, sorry, uh, keep it simple, stay the course. That's the second most important principle. So, in other words, as we all know, markets go through cycles. Some we are currently in what is called a bubble phase. Equities are expensive. If lived in America in the first decade of the century, there was two massive recessions, internet bubble in 2001, 2002, what is called Great Depression 2008, and markets have tendency to fall 50% or more during those time periods. And if you understand your investments, and in my mind, if you are completely convinced in your strategy, which hopefully is simple enough so that you completely understand it, it's easy to go and sustain your investment through this bad phase. As very, very important for long-term compounding of wealth. So stay the course is super important principle, which is very much aligned, and it is facilitated by the first principle, which is if you keep things simple, it's easier to stay the course. And finally, the third important principle that I tend to follow is what I call follow the cash. Now, you businesses are in the business to make money, right? As simple as that. And if I can see business actually making money, what I call retained earnings over a sustained period of time, then I know that business is profitable and they actually are at the end of the day making money that goes into the bank or wherever they want to put it, right? So follow the cash is the most certainly most important principle that I like to follow to understand whether businesses are actually profitable or not. So those are sort of three top principles, and then there are many. As I said, in total nine. But yeah.
Okay. So, by the way, some folks were still complaining about the audio. Guys, I think some people are not having the problem. Even I'm finding it okay. So, maybe on your side, if you can try to be closer, that would help.
Okay.
And just to, I'll maybe try to kind of summarize the key points that Sachin mentioned here, which is keep things simple, stay the course, and then the number third was follow the money. Yeah. Now, Sachin, one question for the audience that we have here: out of these three principles, based on your journey, not just yourself, but with your friends and family and others that you've seen, retail investors, which of these three is the hardest for people to follow, and why?
No, yeah. So as I said, for me, I have hardened these principles in my mind at a point, at a stage in my life where these are almost natural principles that I tend to follow. So I don't find them hard now. But you're absolutely right that over the period of my evolution as an investor, there were certain periods in time where things were very difficult. And one of these top three principles that I have realized, and myself and probably many people have made mistake over their investing journey, is this idea of staying the course. It is very, very easy to stay the course when markets are in ebullient, right? In a bull market, right? When everything is going up, you buy stock, the momentum take trade moves it further. The market goes up, everyone is happy, and you say, okay, I can stay in the business because I'm making money every day. The true test of an investor comes in a period when markets go through this periods of recessions or massive depressions, right? And then they don't happen often. But in the first decade of this century, as I said, it happened twice in, the tech bubble when Nasdaq peaked and then crashed 80% from peak, right? And in 2008, Great Depression when S&P tanked 57%. Now, during these difficult periods, the correlation goes to one. In other words, even if you own excellent stocks, you will suffer massive losses in at least paper losses, right?
Mm.
The whole idea is for you to figure out whether your investments can survive this temporary phase of market depression.
Yeah.
And if you have conviction in your investments and you really understand the businesses that you're involved in, you can draw this idea that even if market tanks 50, 60, 70%, your investment probably may not tank 70, 80%. And in fact, they may actually have mechanisms, they may be doing better in terms of their core business idea. And if you understand the business very clearly, you also should have a conviction that your business will not go to zero, in other words, bankrupt, right?
Got it. So I think, yeah. So if I were to kind of phrase it, sorry to, in the interest of time, I'm just trying to kind of wrap this up. I think it seems what you're saying is staying the course, of course, is one of the biggest challenges that investors face, retail investors, and maybe having conviction in what you put money in. It could be an equity, it could even be a fund, for example, but having that conviction and not being impacted by, let's say, even FOMO today. Like if everyone is investing in the latest AI company, and that might not be the long term, good thing for wealth creation. Maybe don't get caught up in that. Or when the market is going down, and if you're invested in a company you know is going to stay there for a while, fine. Who cares? Because I'm worried about my long term wealth, and I don't care what happens in the next year or so. So maybe staying the course through conviction is what can help our audience a lot. Now, Sachin, I think would like to maybe put these ideas through some examples of your given this journey that you've had. Uh, Maybe give us a very quick summary. I would say maybe a few minutes on your investment process, and then I'd like to dig into some examples with you of things that have gone well or not gone well.
Yeah. So I just want to maybe quickly answer through an example of what I mean stay the course and why it's easy when you understand the business, right? Now, let's say I invest in a company like Friedrichs Chewing Gum. Sorry, my voice is going down. Now, I can almost guarantee that the technology of chewing gum is not going to change in 20 years, right? So it's very easy for me to stay in the business. So that's the idea I mean by understanding the business to the core and figuring out whether there is any moat that can be sustained over a long period of time. Now, in terms of the process of investing, there are sort of two buckets in which I put my approach. So first is continuous learning and continuously updating a list of stocks or quality stocks that I want to invest in. And that list is updated regularly. And my interest is to compile a database of what I call quality stocks that if I would love to buy if I have an opportunity. Now, the definition of quality for me is a business that has, in my mind, a strong brand moat. It is run by management that understands how to run the business and, more importantly, allocate capital. And third is it has demonstrated history of profitable earnings, retained earnings, and it produces products that customers enjoy, and it has a very strong moat around it. So if I can understand these businesses and qualify them as quality businesses, I compile a list of those businesses, and they are ready for me for investments. Now, as I said, I am a contrarian investor, so I truly believe that markets do become manic depressive at some times, and they offer stocks for sale. Now, when such an opportunity occurs and one of these quality businesses is up for sale, then the question that I have to ask for myself is what has changed for this business for market to suddenly become skeptical about the business? So the question then shifts to the variant perspective or the perspective that I can approach or answer because I'm not going against the crowd, right? The crowd is saying the stock has suddenly become very cheap because something has gone wrong with the business. And that is the time period when I really step in. And if I can, in my mind, myself convince a perspective that is against the crowd and understand whether this is a temporary phenomenon affecting the business and not structural, and I of course may be wrong sometimes, and there's a of course tendency to be wrong, and we'll get into that hopefully. Then I go to the next step of my investment process, which is quantitative analysis. And I don't do a lot of quantitative work, but I do run DCF to understand whether a stock is trading for 100, and if I buy for 100, is it a reasonable valuation for me to buy the firm, right? So these are
Okay.
high level two-step process that I follow for all my investments.
All right. So I think you mentioned qualitative factors and quantitative factors. Now, I do see in the chat some folks are asking what quantitative and so on. So what I would say is for our audience here today, I mean, we'll talk through some of these things, but if you're looking for details on valuation metrics, we don't have time to go through all of that. But there was a talk as part of this Southern California talk series last year about valuations in equities, which was done by two of our dear friends, Ravi and Abhi. We'll share the link to that talk. You can, of course, put your questions in this chat window as well. But let me try to go more qualitative and keep things at a higher level and maybe put these ideas to practice. So, Sachin, you mentioned a few times contrarian. I know Warren and Charlie have talked a lot about that. That these are kind of the ideas that work. Walk us through a real world example, something that the audience can relate to, of a contrarian bet that you made, which worked really well, and how you went through that process.
Yeah, so I'm a contrarian investor, and I'm in the business and alive because quite a few bets have actually worked out for me. But for the discussion, maybe I'll pick one of the bets that is an interesting example, and it's pretty much a stock that everyone knows, and that is Chipotle. I'm pretty sure everyone has heard of this company, Chipotle. They make burritos. It's one of the favorite food. One of their products is probably, uh, at least for me, it's one of the best cheap foods that you can buy and uh, you know be happy at the end of the day. So what happened with Chipotle? Chipotle is a excellent business and it never trades cheaply. But something very interesting happened in late 2015, early 2016 for this business. At the time, so Chipotle has gone through stock splits. So I'm going to talk in terms of split adjusted numbers for this discussion. So just in 2015, Chipotle was trading at around $15 in split adjusted numbers, and their net income was around $480 million. And in early 2016, they had this massive E. coli scare. Basically, some of their raw lettuce products that they sell uh, had this E. coli virus. And of course, a few people got sick, and that impacted their business significantly. Now, market reacted violently to that news, in part because the management was not very good in curbing that crisis. But also, market realized that this is a business where if a business is in the business of selling raw food, something like this is more likely to happen than not into the future. And the crisis was such that the market thought that okay, the business has no future, customers are going to go away. So what happened to the stock? Stock went from $15 to $5 uh, immediately after the crisis. And by $15 to about $10 immediately after the crisis. And by mid 2017, the stock was trading at $5. So for me, it was actually a very interesting observation, and I had to understand what's going on. And lesson in history really helped me. So I have been a follower of financial history, and a very similar event happened in 1993 to a company called Jack in the Box. At the time, the stock of JB tanked to $3, basically because of the same phenomenon, E. coli virus impact. In their case, it was through an not properly cooked hamburger. Market punished the stock significantly. But as a consequence of that, back then the management took that crisis and they updated their food safety standards, which basically became a protocol that the fast food industry follows since then. Stock recovered after that crisis and went on to at a peak of $80. So for me, it was a amazing correlation in my mind that a quality business that produces amazing food has this big massive crisis, but if they sustain their business and they keep on producing the type of food they are, they will overcome this crisis and the stock should recover. It was only a matter of time. And indeed, that's exactly what happened. So after the stock bottom at $5, there was few more additional problems like norovirus happened, and then they came up with this queso, which was a product that no one liked. So all these strategic decisions that led to the stock to tank. They brought in Brian Nichols as a new CEO, and at that point, stock bottom. So Brian Nichols brought his skills for digital marketing. He turned around the business, and the stock went from $5 after crisis. It reached its previous crisis in 2019, and by 2024, it was trading at $48. That's about 4x multiple on the stock.
So essentially, it seems that having a historical perspective through continuous learning
Absolutely.
help you kind of identify this contrarian bet in Chipotle when it was going down, when the world was thinking this company is doomed. But you could have been wrong, right? So how do you handle or manage the risk in that case?
It's a very good question, right? So, almost by definition, my strategy of investment requires for me to understand the downside very well. And when I put money into the market, most likely the another stock has still downside 10-20%. So almost by definition, when I'm investing in a stock that is going down, momentum takes it down further. So I have to be very careful in the strategy of how much money I put into the stock and how I do it. So in terms of how much money I put, that is one of my investment principles. No matter how strongly I believe in the fundamentals of the company, how strong my variant perspective is, I do not go over 10% portfolio what I call my highest conviction positions. So there is a very strict limit on 10% of portfolio allocation at cost for my highest conviction positions. Most positions that I invest in are what I called normal positions, which is about 3 to 5%, and then certain speculative positions, which are at 1% of the portfolio. So step one, limit the exposure depending on your conviction or your investment. That's one. And step two, I do not go 10% at a time, right? Because I dollar cost average down to reach 10% of my allocation. So it's just trying to hedge. And I know that when stock is going down, there's going to be opportunity in the near future when I can buy it even cheaper. So as
Yeah.
long as my perspective is correct and my analysis is correct, I'm happy to keep on buying until I reach my allocation state.
Yeah. And I think this is, by the way, great. I mean, scaling in slowly and knowing where to cap your position sizing. So, another thing that you mentioned, and I practice a lot too, is especially for cases where there's uncertainty, like your Chipotle example, there was uncertainty. The company could have gone much down, or even in the world of investing in smaller companies, new AI companies. I think when folks want to invest, first it's about learning about the business, which is important, and also start slow. Don't scale immediately, learn, keep growing, and then size your positions accordingly. So if the bet doesn't work, you don't fail miserably. But if the bet works, then you've slowly scaled into it and you can do super well. So maybe that's one lesson for our audience, not just the Chipotle example, but how to invest in this crazy world today for what they're seeing around. So Sachin, that's a great example, first of all, also of how a bet worked well for you. Now let's get to something where most investors don't want to talk about a bet that did not work well, where you were like super confident maybe that it'll work.
It's that's very true. So I'll pick an example from my current partnership portfolio, and the bet is still playing out, and I still own the stock. So disclaimer, I still own the stock, and that is PayPal. Again, another company that most people probably have heard of. It has a significant brand moat in payment processing business. Everyone is very comfortable using the branded button for PayPal for payment processing, not even in America, pretty much throughout the world, right? So I started buying PayPal in mid 2023 when stock had tanked to around $70. Now that was a drop of a stock from $300 peak just reached after post COVID to 70, which is an almost an 80% drop in the stock price, right? So at the time when I bought the stock, what was the state of the world? The PayPal brand, at least my perception of the brand, was still very strong. They had 430 million active users, or at least registered users for the product. They were doing $1.5 trillion in volume in terms of payment processing. Significant number. So it was all excellent, and the stock was trading at about 7 to 8 times free cash flow. So to me, it was an amazing business on offer for sale. One of the reasons why it was on offer for sale was because market was distracted towards AI, and they had uh, pretty much AI boom had started, and a lot of the money was pouring into Nvidias of the world. So stocks like PayPal, who had made some mistakes, and their brand moat was decreasing, primarily through increasing competitive dynamics from Apple Pay and Google Pays of the world. I think in my view, the market punished the stock significantly more so. So what I did was I started investing. This is a 5% position for me in my portfolio at cost. And if you look at the stock price today, it's around $40, right? So in the intervening period between 2023 to now, what has happened? Actually, quite a lot. So one of the things that happened by Q4 of 2024.
Hey, Sachin, in the interest of time, could you, so we understood that you bought PayPal. I mean, seemed good, but it has gone down significantly, still a position. Could you maybe guide our audience to what did you miss and how has that changed your thinking now?
So PayPal had many things going for it. One of the important things going for it, as it is a cash churning machine. It has produced consistently for a period of long time on the order of $4 to $5 billion of free cash flow. So that, as I said, one of my key principles is follow the cash, right? And so to me, that was a very attractive proposition. What I failed to analyze, and I think it is a structural problem with the business and not a temporary dislocation, is that the quality of that cash flow has suddenly changed. Not suddenly, but it has changed over a period of years. But significant portion of their cash flow used to come from their branded portfolio or branded moat or branded the button that you see that people use to do transactions. That brand mode started going down. The volume of the cash still remained constant, but the volume was compensated by what their unbranded business portions of business. It's Braintree, which is a low margin business. And I think market has realized that the company is structurally broken in the sense that the entire brand mode of the company is no longer sustainable. And I
I
think
see.
the future likelihood of sustained cash for this business is not going to be very high. And I think that's what I missed is the quality of the cash flow and the analysis of what I call the good money and the bad money coming to the business. And I think that's probably I'm guessing my mistake is.
Okay.
Still,
So I think so basically the quality of the cash flow is what is in this case, the lesson learned for you. And by the way, first of all, kudos to you for sharing a painful story. Of course, it's painful for any investor when they have something which is not going well. But I think the mark of a great investor is always can they share their pain that they've gone through with the world. And Warren Buffett is a prime example. He always says, I will keep on making mistakes, but as long as my wins make more than my losses, we are in good shape. So I think the lesson for our audience is keep learning, refining your thinking, and then stay the course with your refined process. Now, let's switch gears a bit. I think our audience would definitely like us to jump into, artificial intelligence, which is the talk of the town these days. We are in the golden age of AI. It's clearly transformative. I don't think there's a day that goes by where most of us is not using the likes of ChatGPT or the new coding tools, Claude Code, and so on. Now, that's on the technology side. On the investing side, we've seen a company which was probably relatively unknown till about 5 years back to a lot of people, NVIDIA, now becoming the most valuable company on the planet. So there's a lot that's going on here. And I think you've also touched on NVIDIA maybe a few minutes back. So keeping the focus on investing, from an investing perspective, what feels genuinely new here and what feels like a repeat of the past cycles, tech cycles?
Um, yeah, so I mean, it's undeniable, right? AI is revolutionary technology, and some say it's the most powerful revolution that has ever happened. So I don't think anyone denies that. So as an investor, if I think about what's going on, I really don't think there's anything new that's happening. I mean, it's so common in the history of finance that basically history in some fashion repeating itself, I would say. So just to give you some examples, right? I mean, there is a technological innovation, AI today. In 1840s, that was a railway, was a massive innovation. In late 80s, electrification of the world happened. In 1920s, radio was invented. In 1990s, we had internet as a revolutionary technology. Each of these examples that I've just mentioned were a breakthrough technology that changed the world at that point in time. Now, if you look into how much money investors made through that period, you'll realize that, with the exception of early investors, most people who flocked in when they realized that this is a revolutionary technology and impacting their lives, they ended up losing money. And I think that is pretty much what is playing out very well in today's era. And typically, when a technological breakthrough happens, the first set of stocks that see massive gains are what I call pitch and fox stocks, right? So the pitch and fox stock today is Nvidia. In 1990s, it was Cisco, if people knew what Cisco was doing back then, right? Any technology needs a backbone, infrastructure, and it takes time to build infrastructure. So the companies are in the business of building infrastructure to run the technology, make a massive gains earlier in the early phase of this technology growth. The key question is, will that massive growth that they have found themselves to be in a position to accrue will be sustained over a period of time when technology actually becomes impactful for the society, right? So in the case of Cisco, as I said, the stock went from $80 to almost $3 by the time it corrected post-crisis. And it took 20 years for it to recover the valuation that it had pre-crisis. Today, Nvidia is trading at 4 trillion market cap, right? Now, if you think about the number 4 trillion, it's comparable to GDP of few big countries in the world, right? And it's probably larger than GDP of 80% of countries in the world. A single company trading at 4 trillion valuation, how much money are you going to make after that is the question that you have to ask yourself, right? If you're in the business of making money over a long period of time, and if you buy Nvidia today, do you think Nvidia will become a $40 trillion company? If you truly believe that over a sustained period of time, it's a great investment. Otherwise, you have to think a little bit carefully. So what I want to say is that AI as a technological revolution is absolutely massive. It is going to change how we think and how we work and how education happens, how software happens, how everything happens for sure. As an investor, if I was smart enough to buy Nvidia very early in this revolution, it was trading, I don't know, $10 at pre-split at one point in time. If I was able to buy, and then if I was smart enough to figure out when I can sell, I'm in the right business. Unfortunately for me, I'm not that smart. So I really don't know when the peak for NVIDIA will happen. And as I said, I'm in the business of figuring out investments that I can sustain through for a long period of time, right? So staying the course. And so, yeah, that's one reason why I'm a little bit wary, although by training and by profession, almost I've been doing machine learning for 15, 20 years now. But the space is so fast and so dynamic that as an investor, and it is, market is very efficient here. I mean, market is pricing it perfectly. So there is no contrarian thesis for me to play here.
I see. So, so I think Sachin, the AI race, like you said, I mean, it is transformative. There are players here. I mean, I classify them into few categories, right? One is the pick and shovels, like the hardware makers like NVIDIA or Grok, and then the model makers like Anthropic and OpenAI, the ones that come to mind, or Google's Gemini. And then, there are people who are going to make tools on top of that, and then there are applications which are going to come about. And I think maybe that application space is still evolving, tools are still evolving. So this story is going to take years to kind of show its true colors and who wins and who loses. Um, you you shared your thoughts on Nvidia, for example, and by the way, I want to make sure people don't take this as a stock tip. It is what from a value investing perspective, Sachin is mentioning, given the valuation of Nvidia today. But can you also talk us through the mental model for these other companies, or maybe take an example of something that you like in the AI space, which is, uh, I would say, which is still using your investing foundation and principles, uh, and still, going to do well, or I wouldn't say going to do well that because it's a stock tip, but you think that's still aligned with your principles and working well in the AI age.
So I don't know if folks go and check my top five positions on my website. I update that every month. You'll notice that one of my highest conviction positions is actually in tech, and it's the only position I have in tech, and that's Google. I
Mm.
started buying Google at 90. And it was at a time when something like you probably have heard of this term called Bard fiasco that happened, right? So ChatGPT came in 2022. Google was trying to compete with ChatGPT. In fact, there was a worldview that Google's business is completely gone now because now suddenly the search mode is no longer a mode. And then Google, in their uh, i- almost urgency mode, they released this product called Bard, which was a prior version of Gemini. And in their publicized event, Bard made a very simple error on one of the very simple astrophysics questions. The market immediately punished Google, and within a period of a week, the company had lost $100 billion in their market cap on a single error made by their one simple product. So markets reaction was such that Google is done for. ChatGPT is completely going to dominate Google now. Market completely discounted their amazing Pixel Android business, their amazing YouTube business. So things like this happen for stocks that are extremely, extremely carefully monitored and followed. So markets are efficient most of the time, but sometimes, as I said, even most efficient stocks have a moment of depression, right? And so for me, as an investor in the space, Google is one of the leaders in the space. And if you look into the research and if you look into how AI happened, like the modern AI, the core technology actually came from Google research.
Yeah.
So do we think that Google was going to stand behind and let some competitor to run over their business? No. And then we found out. I mean, Gemini is now one of the top competing model foundational models out there, right?
Yeah.
So for me, buying into business whose core strength by definition is AI totally makes sense. And then when they're offered for sale, as they do are offered for sale many a times, it becomes a great investment. And fortunately for me, I had an opportunity to take a big stake, and it is what I call my highest conviction positions.
Okay.
So I don't know if that answers the question.
It definitely does. And I think it's a great perspective for the audience to put it together, because I think what you mentioned in this story about Google is, first, you have some knowledge of the space because you are working in the field of AI at GM. So that kind of plays into your core competency as well. Secondly, you had Google on your kind of watch list and you were following it. So you knew what the business was like. And the came together when the Bard fiasco happened. You also knew, because of your learning about the business, that they're playing the full stack. They have the hardware, they have the software, they have the devices, and you put all of that together. The fiasco created that opportunity that you were waiting for, and then you made your move. So I think this speaks to all the core principles that we talked about. And actually, my journey, though we never talked about this, but my journey on Google started a while back. But I think when this thing happened, I did add significantly that primarily for the same reasons that you mentioned. So it kind of aligned well with what my recent journey with Google was as well. Now, so we discussed Google, we discussed Nvidia. There are many more names to discuss. And our audience, I'm sure, is thinking about this day in and out because of all the information that is bombarded at us. Given the historical background that you shared, the 1999, the 1840s or 1920s, what mistakes do you think retail investors will still make in the coming few years or decades when it comes to investing in this new era?
Yeah, I think one of the common mistakes that pretty much everyone tends to make in their investment journey, they're looking at markets like we are in today, is what I call a myopic vision of the markets and not really understanding the financial history. Now, there's this very, very strong idea of momentum, where, when things are doing really well, they tend to do well for a long period of time. And now we are in this era of tech bubble, or you want to call it tech bubble or tech boom, for a period of 10 to 15 years, right? It started since post GFC crisis in 2008, with few hiccups in between, like 2020 COVID and 2022 inflation crisis. Things have pretty much gone along one direction, right? So if you enter the market in any time in the last 5, 10, 15 years, two things are reality to you. One, large tech, not any tech, large tech, like multi-billion dollar tech companies. The names that people use is FANGs or Mag 7. They have done extremely well and they continue to do well. So that's one reality that you are aware of. The second reality that you probably are aware of, that Fed always comes to the rescue. Money
Yeah.
is really has been really, really cheap for a very, very long time, right? So if you take these two realities as your truth, then you expect the world to behave in certain way that it has been in last 10, 15 years. And then you'll start investing in pretty much the same direction. But if you look at the arc of history, something like this that is happening in last 15 years has happened many, many times in the past. In 1960s, we had the so-called go-go years of 60s, right? Or even in the early 1990s, after the suppression of Paul Walker came in and he reduced inflation in America. In 1982 to almost 2000, we had an amazing, massive boom in American technological sector. So things typically go in cycles, and the cycles may last long enough, in some cases decades, for you to then have this belief in your mind that this is how the world works. And I think that is one of the big mistakes as investors, especially in the late stage of this current cycle. I believe we are in the late stage of current cycle, that the world that we lived in, which was free money, and the massive growth of already existing large companies is pretty much at its peak today. So the question that we have to ask ourselves and be very mindful of, are we in a regime change phase? Maybe true. Is the sustained growth that has been seen by massive tech companies going to continue in the future? So these are two critical questions in my mind that one has to be careful as a retail investor today.
So this brings one thing to my mind, and we have especially this audience, right? We have high IQ people. A lot of them have heard these things, like they've probably even lived through 1999. Some of them. Why aren't people able to incorporate these lessons? Why do we keep on making the same mistakes? Especially for this audience, if you can narrow it down.
So why do we keep on making same mistakes, right? I mean, it's okay. I mean, I would say, if you are working in the space of tech, more likely than not, even if you have not done any investment, you probably have done very well for yourself relative to norm in America, right? So because we work in tech, there's this sense that I'm not generalizing, but I'm just saying, I believe that, and I have worked at Facebook for 4, 5 years. There's this idea that no, I'm making ton of money. I really am excellent software programmer or whatever, and therefore I deserve to make a lot of money. And since I know one stack and it has been doing really well, investing is much, much easier. I should be able to easily figure this out. Trivial. So that's this generalization of belief that for whatever reason you are in the arc of history or a time period where you happen to be in a space that is doing good, leads you to believe, internalize this idea that you somehow have amazing level of intelligence, which may be true, and it can generalize to all pretty much fields or endeavors of life, right?
Overconfidence. Yeah, I think the overconfidence once you are in tech is an important thing. Actually,
Absolutely.
we'd like to do an audience poll here. Let's see how self-aware of our audience is, because we've talked through so many of the challenges that people face. So, Dhanashri, could you please bring up that audience poll?
Yeah, I think.
Yeah. So, question for the audience: self-awareness check. What do you think your biggest weakness is in investing? And let's see what we get out of this. I think Sachin has touched on all these points.
FOMO is, I'm not surprised to see FOMO, right?
Yeah, let's see what these get.
It completely reflects how I think of the society today.
Yeah, so let's give these people maybe about 10 seconds or so.
FOMO and overconfidence. I think we touched on these two. So
Yeah, yeah. And even the others one, like the panic selling, the impatience. I mean, you talked about it in the very beginning itself, right? That stay the course, wait for the market to give you opportunities, and keep things simple. Don't overmodel. You don't need complex stuff.
I
Yeah,
think
Dhanush, can we please bring up the poll?
Yeah.
Yeah, Sachin was bang on right. FOMO and overconfidence.
I think FOMO, it comes from this idea of what is called error of omission, right? So if I don't invest in Nvidia, my neighbor is investing in Nvidia and he suddenly has a Porsche and I'm still driving a Toyota.
Yeah.
So, and it's very easy. I mean, why should I? I'm smart enough to drive a Porsche. Why am I
Yeah.
not? So FOMO is so natural in an environment where things are just going up, and it's very easy for you to see in front of your
Yeah.
eyes.
Yeah. So
So,
then, in the interest of time, I have this, one thing I would definitely like for our audience before we hit the Q&A. So, lots of good insights you shared here. We've been on this journey, both of us, for 2+ decades. So I'm sure some folks in the audience are wondering, okay, I have been doing this. I probably need to make a few changes. How do I build a strong investing muscle? And especially, I think, probably for folks who are getting starting into this field. Now, we have to probably put that caveat there that most folks here probably have full time jobs. They are not experts in this field. So, how would you guide them to get started?
let me start by making at least in my mind, an unequivocal statement, right? Concentrated equity investing is not for everybody. And I think you should only find yourself in that space if you are truly passionate about the business. If you are in the business, I mean, you go to neurosurgeon for new brain surgery, right? And there's a reason for that. They are experts in the field. Somehow investing feels easy because it's everywhere. You can just open a Robinhood account and start trading. So for young investors who are coming into the field, first suggestion or a high level suggestion I would have is do some self introspection to figure out who you are and what you like. And if investing is a field that you like, studying markets, studying equities, reading 10K reports is something that you are passionate about, most certainly concentrated equity investing using any strategy that you devise for yourself is a very lucrative path to make a lot of money. However, as I said, investing is a journey. And if you do two simple things, if you make $10 in income, if you pay yourself first $2 before you start spending the money, and take that $2 and invest in what I call index funds like S&P index or equity mutual fund or ETF, right? You don't have to know anything about investment. There are products out there. As long as you're disciplined, and if you just dollar cost average into these simple equity investments, historically markets have returned 4-5% above inflation, right? And if you do two things, if you do this consistently and if you live long enough, the magic of compounding will make you very rich. So I think that's my high level advice to especially young investors.
Right. I think if I were to kind of summarize that part, which about what you just said, it's about save for long-term wealth creation. First, start saving, and then once you save, you have to invest it. If you like doing it in equities, love it, keep doing it. And if suppose that is not your cup of tea after your self introspection, you're like, I better do something else, like maybe a company, a startup, whatever. Then investing in an index is perfectly fine. And if you do it long enough, you'll have a lot of wealth because the magic of compounding is working in your favor as long as you stay the course. All
Absolutely.
right, I think that's a lot of good insights. Uh, let's now jump into some of the Q and A we got, and I'll open up the Q and A document that I think
Yeah.
Dhanashri and Pradyumne have been collaging.
So,
But before we
uh,
go there,
Amit,
yeah,
before I interrupt, before starting the Q&A, we would just like to, take a full house, photograph of
okay.
everybody involved. So
That's
while
a good
you're
idea.
segueing,
We
while
have an
you're
amazing audience today.
so while you're segueing into it, like with the last questions, I would request everybody to please turn on their camera and put your brightest smiles. So sorry, Amit, for interrupting. Please go ahead.
No, no problem at all. So we're taking the picture first, right? Before we jump into the next questions.
Yeah.
Okay.
Uh, I would request everybody to please turn on their cameras for a picture. But yeah.
You have to enable the video first.
Oh, okay. Okay. Let me see if there is some setting that I did. Okay. Apologies.
Or is
Okay. Okay. You should be able to turn on your cameras. Yeah. And until then, please feel free to post all of your questions. We are compiling them on the back end. And if your question was not answered, we will make sure that, both our speakers take a look at the questions and compile those answers and send it over to you guys as a follow-up email. So along with the webinar recording. Okay, cool. So let me, okay. All right. So taking the picture. We have very less number of people turning on their cameras, but okay. Taking a picture now. 3, 2, 1. Thank you so much. Yeah, please continue.
All right. So we got a lot of good questions, but before we jump into the Q and A, Dhanashri, could you please bring up that one question that we had for our audience?
Oh, yeah,
Uh,
sure. Yes, let me just do that.
sorry, and I think the choice two doesn't make sense here, but the question really is, I hope, there was a lot that, came out during this talk, some lessons you took away. But what is that one investing belief you walked in today or you started the stock with that you were absolutely sure about that this stock turned upside down? So we would love to hear your thoughts on that. And it's a self introspection. Take your time, and if you can share it in the chat window while we are doing the Q and A, that'll be great. So with that, let's jump into the Q and A. So curated questions. All right. Uh, so when we stay the course, by the way, guys, I'm looking at another screen, so it's not looking directly at the camera. In case you're wondering, what am I doing? So the first question is: when we say stay the course, what practical checks and balances should investors use to decide whether to hold through the volatility in a sector versus reassess and rotate into more stable areas like CPG?
It's a very good question. So the way I think of this problem is I want to buy 10 businesses that are high conviction positions, allocate 10% of my portfolio, and then go home. So the thing that I'm trying to optimize for is not to maximize profit, but to minimize downside, right? Minimize regret is the framework that I really love. Now, if you just take forward the statement that I made, stay the course is not natural outcome of this statement, right? So I want to buy businesses which I believe are have sustained moat around them and they can stay alive for next 10, 20, 15, 20, or whatever the duration of your investment journey is. However, during that course, there could be instances when stocks can become massively overpriced, egregiously overpriced. Massively is still okay. I'll give you an example. Take Costco for today, right? Costco is an amazing business. I don't own it in my portfolio. I wish I had. It has never had given me an opportunity to take a stake based on my principles. However, if Costco suddenly starts trading at 100 times PE, we know that there is something wrong about this business. It is in the business of selling grocery. A grocery business should not be trading at 100 times PE, right? So this is an egregious valuation. So you now, so that's one clear example of situation when you figure out, okay, this is not something that I want to stay invested in. Another important piece of suggestion that I have is in terms of signal that buy and sell uh, actions give, right? You typically buy stocks for only one reason, which is because you think the stock is going to go up. When someone sells a stock, there is no one reason to sell a stock, right? I may have a wedding coming up, I may have a house to buy, I may have some health crisis in the family. Thousand reasons for which you sell the stock. One of those thousand reasons may be a forced selling situation for you, but if you can avoid that and if you can rationalize yourself to stay in the business, the only reason to sell the stock would be when stocks become egregiously expensive, under the assumption that these are your highest conviction positions. So I don't know if I've answered your question directly as to when to sell. And the reason I have not answered it directly is because it's the most difficult question to answer. That
Yeah, and I think you kind of answered it because what you're saying is your buy and sell is buy when the fundamentals are good, and you keep holding it till the fundamentals change. For example, if it's either egregiously overvalued or something has changed, and to the audience here, which is about rotating through sectors and all, the answer is yeah, why should you do that if you're holding equities where your whole principle is that these are fundamentally good value companies that I own. I think there was another point you made about insider, tracking. There's this also an associated question, which is, what do you think about investing in good CEOs or investing depending on what the CEO profile is and or tracking even the insider buying activities of such people?
so I would say more than CEO, by the way, okay, most important thing uh, is having an excellent management with the track record. So CEO being the head of the management structure certainly plays an important role. But there are two types of CEOs, right? There are CEOs who are hired into the role, and there are CEOs who are founders and running the business, right? Now, founders have significant stake in the business. So you can understand whether the CEO who's running the company actually has significant skin in the game and also has an excellent track record. An example would be one of my big investments in portfolio is Brookfields, right? It's run by a guy called Bruce Flatt. He's been running the company for the last 25 years. He's an excellent, excellent capital allocator, and he has significant portion of his wealth tied to the business. So absolutely critical. But the distinction I would like to make is that founder CEOs typically are much, much more valuable to the business than CEOs who are hired into the role. And I mean, if you're following Disney for now, I mean, Disney has been going through this churn of CEOs for several years, right? And it's a really difficult role to fill in. But
Yeah. I couldn't agree more with that. Either founder or a CEO who is vested into the company with, having the position. Hard to find such good, CEOs. Um, Even though I think Satya Nadella probably is a good example of someone who's not a founder and who's really done wonders for a company that was kind of doing okay.
Correct.
So another question that is coming up is there's so much that comes at us in this information age. What information do you consume, and what information, I would add to that question, is what information do you actually ignore?
So I already answered it partially. It's sell signals I ignore. I mean, I just do not see if I have invested in a stock. I'll give you a good example, right? Bill Ackman started buying Netflix when its stock tanked from 700 to 400 when they had first massive miss in their first earnings report. Now I was got very interested in Netflix as a contrarian investor, and I started buying Netflix as well. It turned out that by the following quarter, Bill Ackman was completely out of the business, right? And actually, for me, it was another strong signal to even buy more. So, what I want to say is that if you follow certain what I call super investors or people who think are good investors, and if they sell their stocks, or if CEO sells the stocks, or if a director sells the stock, to me, that is a signal that has no information in it. So, that's one thing I certainly tend to ignore. Now, if I have a director in the business who has bought the stock, or if a CEO has bought it, even CEO buying the stock, probably the information we get is through stock options that probably got. So there's little information there. But if there's a director of the business who buys a stock, or if the super investor who has bought the stock, that is a very important signal that I tend to follow in the general marketplace, right? Like people
Mm.
who I really believe that their strategy aligns with how I think, and if they are putting money, there is something called 13F document, which is published every quarter. You certainly should be looking into that to understand which super investors are buying, which hedge funds are buying, and draw your conclusions from there.
Any newspapers, podcast you'd like to recommend to people?
The most important magazine, I would say, and I've been reading this for last 10, 15 years now, is Economist. You should subscribe to Economist. I think to get an excellent worldview, not just of finance, but entire geopolitics of the world. That informs a lot of me. So it has been very valuable to me. Second piece of subscription that I take, I have no endorsement or whatever from that firm, but I love Seeking Alpha. I think Seeking Alpha's writers have written amazing articles that have, informed my decisions significantly. So these are two paid subscriptions that I have. And then in terms of podcasts, there are many. One I like is I just love this guy. It's I forget the name. It's called it's a Bloomberg podcast by a guy called Jack Howe.
Okay.
Which is amazing. There's a podcast called Invest Like a Billionaire. It started with a one podcast. Now they have a series of podcasts there. That's pretty amazing. I like to hear. I mean, my podcast is full of so many. Just let me pull some names for you. Um,
You can share it offline. We can share it in the notes if this you need to look it up.
yeah. So I think certainly that I can do.
Okay. So there's a question on
So
macro
House
factor,
podcast is called Streetwise. If you
streetwise.
Streetwise, and that's
Okay.
a podcast. And there are many which I can just later.
Okay. Yeah, it'll be good if you can curate maybe a few things and share with our audience. Now, there is a question which was asked: macroeconomic factors. How do you factor those in, or do
Okay.
you factor those in?
Go to one of my nine principles. It says disregard macroeconomics.
Excellent. That's an easy answer. It's like a Charlie Munger kind of answer. No answer.
Just and the reason is simple. I'm in the business of investing in businesses. So I mean, if I can find quality businesses, the business itself should be invariant to the currents of the world. They may be impacted indirectly or so, but their core mode should not be vanishing, right? So
Yeah.
I really think macro factors are important to time the investment. Like they offer opportunities in a marketplace to get in, and if you're smart enough and follow, at least in my mind, contrarian ideas, actually that's a great opportunity for you to get into good businesses. But once you have identified investment. More generally than not, macro events are not structural events. They are temporary, right? Dislocation.
Yeah. So, Sachin, actually, part of one of these earlier questions, you did bring up this point about following super investors and so on. And I think, some investors like Monish talk a lot about cloning and having no shame in cloning the bigger investors, which it seems like prescribe to the same philosophy. If someone has already done great work and they have a great track record, why not follow them? So could you maybe walk our audience maybe a 30-second pitch on that as to why that is not bad and maybe people should be doing that?
So again, another of my investment principles is low originality. It's very simple, right? In the business of investment, you're not in the business of claiming fame for yourself. You're in the business for making money. As simple as that. Originality has value in sciences. My core training is PhD in physics. I have published a lot of papers. It makes sense to be original there. In the
Mhm.
business of investing, you don't have ownership of an idea, and you should not. I mean, there are significantly smarter people out there in the world with significantly larger number of resources than you to understand and study the investment or stocks or equity, whatever you have. And in today's world of information, though most of those studies are published for people to consume, right? 10K reports are available for you to read. I already mentioned 13F reports are published every quarter. So idea generation, there is no reason for you to be egoistic about this idea that I have to come with original idea and then because I'm brilliant and I understand the world better than anyone else. I don't see any value there. Clone shamelessly, as Monish calls it, or in my words, I loathe originality. In fact, I source my ideas through super investors most of the time.
That's a great point there. Actually, I think, like you mentioned, for people who are doing well in their respective fields, especially tech and high IQ, it's always like, why should I look at someone else? I should do my own. But like you're saying, you're not an expert in this field yet. You can learn from people who are devoting their day in and out.
I mean, even if you are expert, I would say, uh, it rarely makes sense to it take studying a stock takes significant amount of time, and you have to constantly do it, right? And you will
Yeah,
still miss some signals. So,
yeah,
save yourself some time. You leverage information that's out there, and then put your own perspectives onto the stock and see if that the decisions that people have made also align with your framework and whether you should act on that or not.
yeah,
Media generation, you certainly can benefit by cloning or seeking out from the community.
yeah. So Sachin, there's a two-part question here. So I'll say the question out, and but I think the second part we've already addressed in the talk. So it is about, would you recommend a pure value approach or a hybrid of value and momentum, and what practical risk management techniques should one use when taking calculated bets? So I think we have addressed the risk management part about scaling slowly and position sizing. But could you address the first question for our audience? Pure value approach or a hybrid of value and momentum?
So there is a field of study called factor analysis in economics, where people actually systematically study various factors that play a role in investments, right? And the five-factor model, three-factor model, if you've heard of those, where they dissect, okay, momentum as a factor, price to book metric as a factor, price to sales as a factor, etc., etc. Now, to me, these are they are important to understand, but they are certainly not important for decision making. In my mind, I mean, this is nuances of or details. To answer the question whether should I do value investing or should I do hybrid, I would say there's no wrong answer in investing, right? There are multiple ways to make money in the same stock doing exactly opposite thing. So I think the most important thing is for individuals to figure out what is the pond they find themselves swimming in most comfortably and
Mhm.
try to stay in that pond. If you dilly dally, okay, today value is in vogue, I'll put value. Tomorrow, momentum is in vogue. The day after tomorrow, something else is in vogue, and I'll go in and out dilly dally. I think that's probably the worst thing you would do for yourself for a long period of time. I can almost guarantee that if you integrate your journey over your investing history, and if you are jumping from bucket one to bucket two and bucket three, depending on the current trend of the world, over a long period of time, you will end up losing money.
Yeah.
More than being a value investor or a hybrid, you just need to figure out where your comfort zone lies.
Hmm.
How long can you sustain yourself in the market, especially in times when things are hard? And that's pretty much it.
Yeah. Yeah. So, by the way, one quick thing, Dhanashree, how much more time do we have? I mean, there are a lot of questions. We can keep going.
Yeah.
Uh, so, please
I
tell us.
think it's dependent on you and the audience. So because we're not gonna let go of the questions, we can answer them anytime. So it is
Okay.
completely up to you guys.
Okay. So, Sachin, could you stay another maybe 15 minutes or so?
Yeah.
We can talk. Okay. All right. So, the next one is an interesting question, and I think whoever framed this question has done it well, because they actually poked an example. This where they're saying the question starts with, "What do you think about investing in startups?" And to help frame it with an example, they said, "Would you have invested in Amazon earlier on, or the framework that you have had? How would that have made Amazon choosable or investable at that point of time?"
It's a very easy answer. Startups don't fall in my pond of comfort. I like to invest in firms that have demonstrated ability of sustained earnings, as I said. Startups are not those companies. So I 100% completely ignore investments in startup. Just
Okay, I see. So maybe if I were to take the question further, let's say Amazon is IPO now. This is 1999. We are looking at uh, what would your principals have told you about Amazon at that time? Now it's a public company.
to be very frank, Amazon would not even have come to my radar. It's just something that happened in the world that I don't even know about. Because again, I do not focus on businesses that don't have sustained history of retained earnings, period. So there are tons and tons of examples. I'll give you a more recent example. Reddit. I use Reddit all the time. It's an amazing product. Reddit IPO'd last year and a half back. I know the product very well. I just don't know their sustained ability to produce retained earnings over 5, 10 years time period.
Hmm.
It's just not a stock that I'll put my money in. So IPOs, startups, pre-IPO, venture, all these are great places, but they are just not the pond in which I fish.
Okay, so it's kind of coming to your follow the money principle. Show me the money before I
It
dig into
comes
you.
it that and also it comes to the pond in which I tend to hunt. It's just not my pond. So
Okay.
it's very clear. That is, I don't venture into a pond that is not my pond. As simple as that.
Great, great. I think that's a great way to frame it. So, Sachin, you talked about position sizing earlier, and I think a lot of people might have this question. I used to have this question a while back as well. At least I've answered it for myself. But the question is, you see, don't put any stock more than 10% in your portfolio, and that means you'll have at least 10 stocks, if not more. I think most investors I've seen, they have somewhere between 10 to 30, depending on the investor.
Finding
Uh,
10 stocks that are exceptional and high conviction positions
is
is,
already
is a dream.
yeah.
It's
So
my
the question,
nirvana.
yeah. So for you, yeah. So you were already saying finding 10 is tough, and then people will have maybe 10 or 15 or 20. So the question is, that seems like building a personal mini mutual fund. How does that compare to just simply buying an S&P 500 index fund?
Maybe I don't understand. How is it personal mutual fund? It's just concentrated investing, right? So
I
as
think maybe to frame it, yeah, they're saying it's a bunch of things that I'm buying by choosing, like 10 or 20 versus S&P, which is 500. So maybe the question is, why should I do this versus the other?
by the way, index you don't choose. It's market, right? You put money into the market without thinking.
That's right.
If you're nuanced about index, there's something called market weighted index,
Yeah.
uh, uh, uh,
Equal weighted.
equal weighted index, right? Which is an RSP ticker for S&P. So those are nuances. But at the end of the day, when I put money in a mutual fund, and there are what I call flavored mutual fund, right? 3x leverage NVIDIA fund or whatever you want. I mean, just
Mm.
in my mind, ignore those. Like the best thing you can do if you don't really understand equities, I've already answered that in my mind, is to buy the market. And you'll get market returns, right? And those have been not bad. They produce 10%. So to answer the specific question of how investing in 10 stocks is not mutual fund, in fact, 10 stock investment is, well, I don't think in my lifetime I will have only 10 stocks. I mean, as I said, that's the extreme nirvana state for me. Typically, what happens is three or four or five positions or 10% positions, high conviction positions, and most of them fall in 3 to 5% bucket. So in at any time, I'll have between 10 and 20 stocks in my portfolio. It is concentrated investing just by definition. You have few select stocks where you have invested all of your money in, and then you rigorously try to monitor those investments. It is completely opposite of throwing money to market, which is index investing in S&P or Dow or Russell or whatever you want to pick it, where you don't choose individual equities. You say, okay, I'll just buy this index and I'll get the returns that the index produces.
And can I maybe also say, where you addressed this earlier in that question about process and guidance to folks, I think it comes down to personal introspection as well. If, like you said, equities is not your cup of tea, just do indexing. And if you love the art, then start doing equity investing and there use these principles to make this mini fund of yours. But the whole point is not about am I just going to beat S&P 500 this year or that. It is about I love the art and I'm building this for myself. And if I don't love it, but I still need the wealth creation, then just go to an index fund. So, is it fair to say that that's kind of the process our audience should use and not say, yeah, is this going to be better 10 stocks versus the index fund? That probably is not the game to be played.
I mean, it's a game to be played if you are really interested in understanding and studying the stocks, right? As I,
Yes.
if you are in the business of long-term wealth creation, and if you have no interest in investment, you like traveling, travel and just put money, dollar cost average into the market. You get best of both worlds, right? You
Yes.
market returns and you'll enjoy life because you're doing something that you really enjoy. In my case, that enjoyment comes through investment. So I just, I mean, it's again, it's just, I don't know why my mind like in studying about stocks, but that's the joy that I get out of it, and
Mm.
happens to make a lot of money for me. That's an added bonus, right?
Yeah. There is a question on options. And the question is how do you fight the mindset of getting rich quickly using daily volatility instruments such as options?
I'm laughing because it's so funny. If you look at my blog or my portfolio, I'm in the business of what I call sustained wealth creation. So sustained wealth does not happen quickly. It happens over a period of multi-decades. So it just never occurs to me that I can actually trade volatility or make money quickly. I mean, that just doesn't. I want to strongly emphasize this idea of being comfortable in the pond that you are fishing. And error of omissions are everywhere around you. If you are a person who likes trading, taking advantage of Black Scholes option pricing model or whatever, and if that's where you find your comfort zone, more than happy, just stay in that space. And you probably are excellent in that space and make a lot of money in it. So there's no right or wrong answer. I mean, I wouldn't say someone who's doing options trading who's buying Bitcoin that you're stupid or whatever. No, no, no. It's just a different pond. That is not my pond. So that's one answer to the question. Now, in terms of how invest derivatives or options strategies work for me, there are instances when markets get expensive, right? I have a concentration investment in Google, for example. It's 13 or 14% of my portfolio. Now, it does make sense for me to see if I can generate some income from this concentrated portfolio, right? So I do something called covered calls. And the idea is that I'm very happy if the call gets exercised to sell at a stock price, which is already priced significantly. And if it expires, then I have made free money, right? So it's a very safe strategy to generate additional income based on the portfolio of stocks that you already own.
Hmm.
So again, that fits into my framework of investing and how I want to continue investing. And so option strategy, s- selling covered calls, selling put to buy stocks that I'm interested in. As a contrarian investor, another strategy that I follow all the time, simply because I want to buy quality business cheaply, I might just sell some puts and make some money upfront. And if the stock falls to my value, I already have it on my radar to buy. I'm happy to get the stock.
Okay.
These are the plays that I do in the options world.
So
That's
basically, I think what you're saying is you're using options a little bit in your portfolio only for these scenarios that you
for income
mentioned,
generation, basically.
income generation, and it's not really like a major pinhold of your strategy. It's really like aiding it a little bit for income generation.
And option. So people are technical minded here, right? So if you think in terms of I'm optimizing for minimizing decisions. You know, I want to minimize the decisions that I make in my investment career. If I have to play options game, I have to first of all figure out the right price at which I want to buy. I need to figure out how much in the money the stock is or out of money. What is the expiry date? I mean, it's just too many decisions to make. That's not the business that I'm trying to optimize for, right? My optimization is minimize downside and minimize decisions.
Yeah. Okay. By the way, I think Sachin, you talked a few times about this pond, and I think this question about get rich keeps coming up because I think people are trying to run after a goal, but there's really no goalpost. The goalpost is moving. Whereas I think for you, and maybe that's a topic for another discussion, you've been focused on a goal for you and your family, and getting there slowly was also okay for you, versus this is a get rich scheme about getting to where the next person is and where the next person is. Could you maybe share your thoughts on how you arrived there, and how our audience can really get to that goal based mindset for themselves and not chase something which is never ending?
Um, Again, this is very personal, and so the way for me to think about this is very simple. I know my lifestyle. Even if I have $100 million, I don't see I'll buy a yacht. Right? That's just not my lifestyle, nor is my wife's lifestyle, right? Or my kids. So if I know my lifestyle, you can work backwards from there, right? What is the annual cost to run that lifestyle? You come up with a number. Then there's an entire community called FIRE, Financial Independent Retire Early Community, where they take that estimates and they determine how much money do I need in my bank to sustain that lifestyle. And that's
Yeah.
called financial independence number. So the way I have done my calculations is I have worked backwards from I first of all understand my lifestyle. I own this home. I'm very happy here. I don't see myself buying any more homes, right? As an example. So I want to sustain my lifestyle. I have an annual cost to run that and sustain that lifestyle. And I have a multiple in the fire community called 4%, which is basically if you have $1 million liquid portfolio, and if your lifestyle can run on $40,000, you can easily not worry about 30 years of your life period. You'll be okay. So that's a concept that I have ingrained into myself in my definition of what financial independence for me is. Once I've reached that stage, at that point, I'm suddenly free to do whatever I want to do.
Hmm.
And that was a transition point for me to start this partnership because it is really not a vehicle for me to make something more than what I'm already at a level where I feel comfortable.
Yeah. Yeah.
Right. So I think maybe that framing of at what point you want to stop, would just describe is probably a good framing. And then after that, anything additional is bonus for you. I mean, everyone likes to make more money, right? I mean, more money is not bad. But if
Yeah.
you are not sleeping and if you're having stressful nights and if you're worried about getting fired from your company tomorrow, you're probably not at a stage where you're financially independent, right?
Yeah.
I think to me that's the nirvana stage in personal finance space that I feel everyone should reach. And the only way to reach there is have a clear understanding of your current lifestyle and your future lifestyle goals.
Yeah, and I think I remember this quote that Morgan Housel had in one of his books. He said, "Define a goalpost that's for you, and then don't keep on moving that goalpost. Once you reach, your goal, don't keep on, increasing it, because then you are never really reaching that calm or nirvana state, like you said.
This lifestyle creep is very, very, very common. I mean, I have an iPhone 13, and today iPhone 17 is in the marketplace, right?
Yeah.
You see your friend's son, which is 10-year-old, has an iPhone 17. I mean, you have to ask yourself this question, right? Do I
Yeah.
have to use
That's right.
with my phone? So that's what I mean by there are temptations everywhere to increase your lifestyle creep, and you just have to make a call. I mean, it's not that I can't afford iPhone 17. I mean, but just as an example, right?
Yeah. Hey, Sachin, let's take one last question that came from the audience before we try to close it. Of course, being cognizant of your time here as well as the audience. What what percentage of your portfolio do you keep as cash while waiting for buying opportunities?
My ideal situation is to be fully invested all the time. That's my ideal, and that's what I try to do. However, situations like this, where in the current marketplace, I feel I need to have some cash. So, as I said, my ideal is fully invested. In situations where I perceive that we are at the peak of the market and we are due for correction, I typically tend to keep 5 to 10% of my portfolio in liquid cash.
Okay, I see. So let's say you were in the market fully invested. New money came in. Uh, what do you typically do? Do you uh, try putting it into your best idea, or you're looking at something else now? How do you
Like,
decide that?
new money, already I mentioned my investment process, right? I have a list of ideas that I want to make money work. But money coming in may not be timed to when opportunities arise in the marketplace. So typically, when coming money comes in, it sits into uh, short-term assets like SGov, which is basically a treasury equity. And then when I find an opportunity to invest, that money is put to play. So
Okay.
there's absolutely no reason for me to, and the my investment partners are I'm very selective in terms of who my investment partners are, right? They are people who are completely aligned with my strategy of investing, right? We are in the business of long-term compounding wealth. So I have a complete buy-in from my investors in terms of how I deploy money and when I deploy money.
All right. Well, we took on the questions that the audience had. I think there are a few more, but we are already 11:46. So let me maybe close this talk by pulling together some of the biggest lessons we had today. I think for the audience, complexity is really your enemy when it comes to investing. Keep it simple. You do not need complex spreadsheets. Keep that for your, tech jobs. Have a process and follow it rigorously. Now, that process could be as simple as I dollar cost average into an index fund, and that's fine. You will still make a lot of wealth if you do not deviate from the path. And third, the last point I would like to mention here is success in investing depends a lot more on your temperament than it does on your IQ. So, especially what you do in euphoric times like we are in today, and what you do when everybody's panicking, like everybody was in 2008, is really going to define your long term wealth trajectory. So, with that, Sachin, thank you so much for being candid, sharing some of your stories, even the stories where you've not made money, being very thoughtful and generous with sharing your process. I'm sure that our community here learned a lot today, and I really want to thank everyone here, the volunteers, as well as the community, for their questions and engagement. So, with that, Dhanashri, back to you.
Before that, I also want to thank you again, Amit, first of all, you for excellent questions. I think I really appreciate it. And to Priyank and Dhanashri, who are the drivers of this organization, I really appreciate this opportunity.
Yeah, thank you so much. So, and that's a wrap. So, again, I would like to thank Sachin and Amit for taking out time from your really busy schedule. You really brought clarity, depth, and real world wisdom to a topic that can often feel overwhelming to a lot of people. And we are truly grateful for your time and sharing, like, not just the good side of investing, but also the bad side of investing, and making it like a very clear thing for everybody involved. And again, I would really love to thank all the volunteers who helped us managing the event. Priyank, who is the president of IIT SoCal Alumni Association, was like the greatest volunteer for all of these events, from ideation to execution. And we also I'd also like to thank Deepak and Hari for helping us with the backend. And to everybody who joined, thank you so much for your energy and thoughtful questions. We will go through all those questions and reply to them. So please please look out for our email with the webinar recording and answers to all of your questions. And it's not the end. Even if you think of new questions, you can always email us and we will reply to all those questions. And this is exactly the kind of exchange that makes our community really special. And as a closing statement, please follow us on LinkedIn. Take a look at all the next interesting events that we are hosting. And if you have any ideas for more events, please reach out to us. And that's it. Thank you so much and have a great weekend, everyone.
Thanks. Yeah.
Thank you. Have a great weekend. Bye.